Hi guys, welcome back to Father and Son Investing. Buy low, sell high. That's the way to make money in the stock market, right? Last year when all of the airlines were having difficulty, I bought 4 different airline stocks, and all of them have come up nicely. Well, except American. Today I want to talk about an industry that is currently on a dip for many of the stocks, and that is the mining industry. There are 3 companies in particular that I want to talk to you about. So let's get to it. All right, I'll take these in order of my least favorite. I like all 3 of these, but least favorite to most favorite. We're going to start first with MP Materials. I'll be using a lot of data from Simply Wall Street today because they have some nice graphics that make this easy to talk about. Now, there are some negatives with MP Materials, one of which is the price to earnings ratio. That certainly is high compared to other companies here, 71 times price to earnings. Earnings per share is only 46 cents per share. When we look at their margins, gross margins not so bad, 66%, but net profit margin is down significantly from that. Their debt to equity ratio is generally high, 80%. We'll compare that to the other companies, the other 2, and we'll see that that's high. Their price to book value is also not as good as the other companies within the U.S. metals and mining industry. So where is it that I see that this company is potentially a buy right now? Well, their future growth is predicted to be 32.5% in the next 1 to 3 years. When we look at their earnings and revenue growth forecasts, we'll see that those are both increasing nicely. And just another graphic to illustrate that point, the industry is projected to decline by 5.2%, with MP Materials growth projected to be again 32.5% on the earnings. Here's one more reason to consider this company as a buy low, sell high candidate, and that is its fair value. Now, Simply Wall Street uses the discounted cash flow formula of calculating value. If you're not familiar with that, they're going to take the estimated cash flows in the next 10 years and then discount that back to the value of $1 today. So discounted cash flows. We'll see that it's 17% undervalued utilizing that model. If you're not familiar with MP Materials, they are a rare earth minerals mining company that operates out of a mine in Nevada in the United States. They really are for all intents and purposes, the only rare earth mineral mining company of any value or of any significant production within the United States. Now, the United States government is concerned about some of this for national security issues. Right now, all of the rare earth mining minerals that get mined are really being sent to China for processing. The United States would really like to bring some of that back into its boundaries. Therefore, MP Materials, while they are not necessarily a refining company, they are looking into some of that to do that on their own, and the United States certainly would be interested in that. My next most favorite of the 3 companies I want to talk about is Valet. They are a mining company that's headquartered in Brazil. They really produce iron ore. Now, they do also mine some other things like copper and nickel, but the vast majority of their revenues is going to come from iron ore. Now, if we look at the stock price trend on Valet, we're going to see that their stock has declined significantly in price. It was selling in the $22 range earlier this year and currently selling in the low $13 range. Why has their stock price declined so significantly? Well, China is really coming down hard on their steel producers. Most of the iron ore that Vale is producing is going to be going to China. China's cutting down on their steel production. They really want to be carbon neutral by 2060. And in order to do that, they feel like they need to decrease the amount of steel that they are producing. Because of that, there is a fear then that Vale's revenues will be declining in like manner. Now, one important thing to know about China is they're not intending to decrease their steel use. In fact, they're going to be importing more steel. So in my opinion, although the short-term revenue for Vale may be declining because of China's coming down on their steel production, I think that steel production will ramp up elsewhere in order to meet the same demand for steel. Now, when we look at some of the statistics about Vale, they're really very good. Their price to earnings ratio, 4.1. Remember, MP Materials, 72. This company is a massive free cash flow producer. Look at their revenue of $294 billion, with the cost of revenue being $113 billion. We see their gross profit, $181 billion. We look at their earnings, $91 billion. They are producing free cash flow like crazy. In fact, they've been buying back shares this year to the tune of about $2 billion, and they have been issuing a higher dividend. In fact, recently their dividend was up to about 13%, but with the decline in the share price, it's more like 20%. If we look at that same free cash flow model, we'll see that they are also considered undervalued by about 12%. Now, of course, analysts are predicting that Valet's future earnings growth is going to decline significantly. Again, I think that may be more of a short-term problem as steel production elsewhere ramps up. I like this company. In fact, I bought some more shares earlier this week. All right, my most favorite right now is Freeport-McMoRan. It looks like McMoRan, but it's McMoRan. They are a big copper producer. Of course, copper goes into many things, but one of the big things it goes into is electric vehicles. And of course, electric vehicles are going to be produced more and more in the near future. Now, copper prices have risen significantly over the last year. They're up in about the $4.60 range right now, from previously down in the low $3 range last year. If we look at some of the statistics about this company, we'll see that its price to earnings ratio is not as good as Valet, but certainly not as high as MP Materials, 13.9. Their margins are not as great as Valet's are, 46% gross margin and only 18% net margin. Analysts are also saying that their future growth will be down. Remember that the U.S. mining and metals industry is showing future of about 5.2% negative growth, so they're better than that. I think this remains to be seen. Again, the demand for copper is just going to increase and increase over the next few years. Here's really, though, where I'm excited about this company as one of those buy low and sell high candidates, and that is that discounted cash flow model is showing this company 67% undervalued. 67% undervalued. So I like all three of these companies as a potential buy low, sell high. I certainly got a great deal buying, well, Almost American. That one hasn't paid off quite as well as Delta and United and Southwest for me. Now, these three mining companies are certainly not the only ones in this industry that may be worth taking a look into. In fact, this article from Stock News that appeared on the 22nd of October highlights three other companies: Rio Tinto, BHP, and Nexa. And the writer of this article all feels like those companies certainly are ones that could be bought on the dip. All right, I hope this information was useful for you. If it was, please give us a thumbs up. We'd love to have you as a subscriber. As always, please share this kind of information with a young person in your life. And until next time, enjoy your investing.